In today's video, we're going to be discussing how every single Forex robot works and the framework that I use to evaluate Forex robots. So really, when you think, what is a Forex robot or expert advisor? It's fundamentally a series of instructions which has been put in code form. The bot is nothing magic, it's just pretty much Boolean instructions, if this, do this, given to a little piece of software which runs on MT5. So fundamentally, when you're evaluating a bot, you should try and see what those instructions are. And the core principles behind any sort of bot or any sort of series of instructions would be, what is the trigger, what filters is it using, and what is the money or position management which it's using. And these three core elements can tell you how most bots work and can help you as a user understand why it's deciding to take and manage a trade in a certain way. So starting us off with trigger. What does trigger actually mean? This is why the bot is deciding to enter a position. And it's quite simply the instructions given by the programmer or by the developer telling the bot to enter once a certain condition has been met. And this could be as simple as time. So at the end of the first 5-minute candle of the session, buy. That would be a time-based trigger. You could also have a fundamental-based trigger. So let's say, for instance, if the natural gas storage report comes out and there's a certain amount of natural gas in storage above expectations. That could be a fundamental based trigger that, hey, maybe I'm going to go short natural gas because there's more in storage than I had expected, and I can quickly act on that based on the fundamental reason, which would be the storage. At the same time, we can look at a very classic trigger, which is the support and resistance based triggers. This can be a very simple breakout system where you can place pending orders at highs and lows of a certain point on various time frames, be it an H1, at M15, and pretty much trade the breakout of those levels. You could also be looking to do like a counter trend trade where you place a limit order at a support or resistance level and then either buy or sell kind of against the direction of the trend because you want to be trading more of a channel. And finally, like the most classic one here would be an indicator-based trigger. And many trading bots are based on indicators. This could be an RSI, a Bollinger Band, a stochastic, and there's really a whole bunch of different things which one could use here. But really that comes down to it. Like, why is the bot deciding to trade? So if you ever evaluate a trading bot, you should try and get like, why is it making the decision to enter a position? What is the underlying strategy behind it? Because that will then help you decide whether or not it's likely to be overfit or not. So a great example here would be if the trigger is the RSI of length 16 crosses the RSI of length 14 and it's Tuesday, that's probably likely to be overfit because you're just randomly picking indicators, and is there any fundamental reasoning behind it? Who knows? Whereas if you have a time-based trigger to enter a position literally 2 seconds before the New York Open, that might actually be fundamental, right? Because then all of a sudden there is some sort of real event happening, which would be the New York market open, and you're trading in accordance with that event. So perhaps there's something there. Maybe it's more of a real strategy. So a really interesting thing to kind of evaluate a bot based on is why it's deciding to enter a position. Another extremely important thing is filters. So oftentimes when a developer makes a system, there's a few different ways to do this. Ideally, you should not add filters after the fact. And this is an extremely common mistake that developers make. And the very simple mistake that they would make is they first try a certain trigger. Let's say a certain support and resistance based trigger. And it doesn't look that good when they run a back test. So the immediate thought they have is, oh great, let's chuck a bunch of filters on it and see if it improves performance. This is usually a terrible idea because you could just be overfitting. So let's say, for instance, you do your basic trigger and then you add a trend filter like an EMA, or maybe you add a fundamental filter like only trade on Tuesdays. And then perhaps you add even an RSI filter like an overbought, oversold filter where you're only taking trades if a certain condition is met. And that's really dangerous to do after the fact because you could simply be overfitting by chucking a boatload of filters on top of a mediocre trigger. The real way of doing this and how you should do this is before you actually develop a strategy, you should kind of come up with an idea for a filter and a trigger simultaneously. So a great example here would be, hey, we want to trade based on put-call ratios. So options data, that's our fundamental trigger. And we're going to use like a day of week filter where we're not going to trade Mondays, because on Monday, our option data is going to be a bit older. Because we know that with put call ratios, if we're trading based on the prior day's options trades, options volume, that's our trigger. If you try and trade on Monday, that data is coming from Friday. Whereas if you're trying to trade on Tuesday, that data is only a few hours old coming from Monday. And because of that, it's logical that you would use a day of week filter here to complement the trigger. What you're not going to do is take the put call ratio and then run a gajillion back tests and find that if you trade on, I don't know, in December or on the third Tuesday of every 2 months, then that's probably just data mining, right? And you're likely, if you don't have a real reasoning behind it and you're doing it after the fact, it's too easy to actually overfit something. So that's also something to assess when looking at a bot. What are the filters, and are there too many filters? If you ever look at something and it's just like indicator soup, where you see like a whole bunch of different filters, you got to really think, like, how did the developer make this bot? Did he just chuck on a bunch of filters afterwards, or did he actually have a real reasoning behind it? You got to ask yourself the question. Finally, we can go to the money or position management. This often includes things like stop loss, lot scaling, and even it could include stuff like, I don't know, when to actually get out of the position and more exits. So a great example here would be a grid martingale, which we all know is when people don't actually close losers, but instead average in with an increased lot size. We could also look at basic take profits and stop losses, trailing stop losses, and forms of lot scaling, which include recovery. And this is also really important because the first part of your trade is getting into the trade. Your second part is getting out of the trade. So if you don't know how the bot decides to get out of a trade, you're going to be missing a lot. So this is really, really critical. And many different systems, like a huge chunk of your edge actually comes from the exit. Now, I think Kevin Davey once said this, that you can flip a coin. Dr. Robert Van Tharp also said it, whereas essentially you can flip a coin to enter, provided your exit is good enough. So when you evaluate a bot, you need to assess what technique are they using to get out of the position, and is there an edge? Anecdotally, I have found that trailing stops usually give you the best edge. Why is this? Because oftentimes you can have those big runners, and that can significantly improve your risk reward overall. Whereas if you use a fixed take profit, usually what I have found is that your risk reward is not nearly as good over enough of a large enough sample size, and you typically tend to reduce your overall profitability. But people have different opinions on this. That's just mine. You can also look at stuff like lot scaling and recovery, more to see if there is an element of risk to the bot. For instance, many times when people sell third-party EAs, they will put a recovery aspect into it because it's easier to sell. Because when you run a back test, if you use a recovery factor, where after every loss you immediately double the lot size, it makes your back test equity curve look amazing. The issue is, if there's a permutation of the trades once you run it live, you can be in some serious issues. So that is one thing to really keep in mind to assess the riskiness of a certain strategy. So guys, to know how any bot works, look at the trigger. Why is it entering a position? Look at the filters. What scenarios is the developer filtering out? And did he do this at the beginning, or did he do it after the fact? Finally, how is it deciding to manage the position, scale lot sizes, and deal with exits? If you can assess all of these things, you understand how a bot generally works, and you can then make a critical decision whether or not it's a good strategy or if it's just a bunch of overfit garbage. So guys, hope you enjoyed the video, and I'll see you in the next one.